Renewable energy sources are increasingly being used to mitigate the environmental footprint, with some mining operations investing in solar, wind, and hydroelectric power. The economic incentives for mining are twofold: the block reward and transaction fees. When a miner successfully adds a block to the blockchain, they receive a block reward, which currently stands at 6.25 bitcoins but is halved approximately every 4 years in an event known as the halving. Additionally, miners collect fees from the transactions included in the block. These rewards incentivize miners to continue validating transactions and securing the network. Despite its decentralized nature, Bitcoin mining has seen significant centralization due to the rise of mining pools. These pools allow individual miners to combine their computational power, increasing their chances of solving the cryptographic puzzle and earning rewards. The rewards are then distributed among pool members based on the amount of computational power contributed. While mining pools make it easier for smaller miners to participate, they also concentrate mining power, raising concerns about the potential for a 51% attack, where a single entity controls the majority of the network's hash rate. In conclusion, Bitcoin mining is a vital but resource-intensive process that underpins the security and functionality of the Bitcoin network. It balances economic incentives with computational challenges, ensuring the integrity of the blockchain while continuously introducing new Bitcoins into the ecosystem. However, the environmental impact and increasing centralization pose ongoing challenges that the community continues to address. Our expert advisor is active. Bitcoin mining is a global activity, with certain countries emerging as significant players due to favorable conditions such as low electricity costs, supportive regulatory environments, and access to technological infrastructure. These factors collectively determine where mining operations are most viable and profitable. China historically dominated the Bitcoin mining landscape, accounting for a substantial portion of the global hash rate. This dominance was largely driven by the availability of cheap electricity, especially from coal and hydroelectric power plants in regions like Sichuan and Xinjiang. However, in mid-2021, the Chinese government imposed a sweeping ban on cryptocurrency mining and trading, leading to a dramatic reduction in China's share of the global hash rate. This regulatory crackdown forced miners to relocate their operations to other countries. Following the exodus from China, the United States emerged as a major hub for Bitcoin mining. States like Texas, Wyoming, and New York have become attractive destinations due to their favorable regulatory climates, access to cheap and renewable energy, and established technological infrastructure. Texas, in particular, offers abundant wind power and deregulated electricity markets, which have drawn significant investment from mining companies. Additionally, the political support for cryptocurrencies in certain states has further bolstered the U.S. position as a leading Bitcoin mining nation. Kazakhstan has also seen a significant influx of mining activity post-China's ban. The country offers relatively low electricity costs, largely derived from coal power, and a generally supportive regulatory environment. However, the rapid growth of mining in Kazakhstan has strained its energy grid, leading to occasional blackouts and prompting the government to reconsider its energy policies. Despite these challenges, Kazakhstan remains a key player in the global Bitcoin mining industry. Other countries with notable Bitcoin mining activities include Russia, Canada, and Iceland. Russia benefits from vast natural resources and a cold climate, which helps reduce cooling costs for mining equipment. Canada offers access to hydroelectric power, especially in provinces like Quebec and British Columbia, making it an attractive location for environmentally conscious mining operations. Iceland, with its abundant geothermal energy and cool climate, also provides an ideal environment for sustainable mining practices. In recent years, there has been a growing emphasis on the environmental impact of Bitcoin mining, leading some countries to leverage renewable energy sources for mining operations. Countries like Norway and Sweden, with their ample hydroelectric and wind power resources, have become increasingly significant in this context. These nations not only offer sustainable energy but also align with the global push towards reducing the carbon footprint of Bitcoin mining. In conclusion, Bitcoin mining is a geographically dispersed activity influenced by a complex interplay of economic, environmental, and regulatory factors. While the landscape has shifted significantly, particularly with China's exit, new leaders like the United States, Kazakhstan, and several other countries have stepped up to fill the void. The evolving nature of mining regulations and energy policies will continue to shape the global distribution of Bitcoin mining activities. Light discussion on various aspects of trading, from risk management to mindset and strategy, that are of great value to everyone, especially new traders. Before elaborating my trading strategy, I would like to advise new traders that their first target, as a crypto trader, should be to save your capital. Once you have mastered saving your capital, then go for earning from crypto trading. And after getting the skill of earning, you should try to become rich or millionaire by crypto trading. But if you directly want to achieve third level, you can never be profitable. The crypto market is very uncertain. There is no strategy that is always 100% profitable. Risk management, proper psychology and control of emotions are the factors behind my strategy. I may be in loss, in a session or in a day, but not in a week or a month. That's how things work in the life of a crypto trader, and that's the beauty of crypto trading. The key points of my trading strategy are: I do semi-automated trading. It's very difficult for a human to control his psychology and emotions during trading in highly volatile market of crypto. That's why I believe software tools are necessary in crypto trading. I use hybrid approach in my trading that involves human input as well as my own developed expert advisor, EA, algorithm to hint for best entries in trendy and sideways market, keeping in view the running fundamentals of the market. My EA doesn't follow the direction of any daily technical analysis, but looks for suitable entries in both directions, sell and buy. The TP, SL and break-even settings are performed by the EA bot. That really makes my work easy. I constantly keep on improving my EA to improve its performance. I trade all sessions. No doubt, there is more trading volume in the market during New York session and during sessions overlapping. However, good opportunities can come any time. That's why I love to trade all sessions, looking for nice entries. I take multiple positions in same direction. Whenever I found a suitable entry, I run multiple positions of same lot size and same stop loss, but with different take profits. One of these positions will have open TP, in order to take maximum benefit from big market moves. Sometimes my SLs may trigger in a row, but these net SLs are much smaller than my net TPs. That's what makes me profitable. I do break-even of remaining positions after 1 or 2 TP hits. In my trading, when 1 or 2 TPs are hit, I move SLs of all other running positions to break-even level. This may deprive me of taking benefit from my entry, if market retests my entry level and then bounces back in my direction. In this case, I don't take next entry in same direction. I'll wait, and the waiting period sometimes may extend even up to a couple of hours or so, until I found an opportunity in opposite direction. Then I will take my next entry. Bitcoin is working. Trading support and resistance levels is a core strategy in technical analysis, providing traders with critical insights into potential price movements and key decision points. These levels represent psychological barriers where prices tend to pause, reverse, or break through, influenced by the supply and demand dynamics in the market. Support levels are price points where a downtrend is expected to pause due to a concentration of buying interest. At these levels, demand for an asset is strong enough to prevent the price from falling further. Traders look for support levels to identify potential entry points for long positions, anticipating that the price will rebound from these levels. For example, if a stock repeatedly falls to $50 and then rises, $50 becomes a support level. Confirming a support level involves looking for repeated bounces off this price point and analyzing volume patterns, as higher volume at support levels can indicate stronger buying interest. Resistance levels, conversely, are price points where an uptrend is expected to pause or reverse due to a concentration of selling interest. At these levels, the supply of an asset is sufficient to prevent the price from rising further. Traders use resistance levels to identify potential entry points for short positions or to exit long positions, anticipating that the price will drop after hitting these levels. For instance, if a stock repeatedly rises to $100 and then falls, $100 becomes a resistance level. Confirming a resistance level similarly involves observing repeated price rejections and volume patterns, with higher volume at resistance levels suggesting stronger selling pressure. Trading support and resistance involves several key strategies. One common approach is range trading, where traders